In the financial markets, people, those who want to borrow money or to raise capital, and also those who have surplus funds like in the form of savings, they will meet in the financial markets. Now, again, there are a lot of financial markets in the United States. In the United States alone, we have the New York Stock Exchange, Chicago. Now we have types of market. First, the markets is different from physical asset markets. And physical, we have that commonly that we can get like in the market. For instance, in Walmart, we can have the goods that we purchase from there, and for those who are selling some autos like that and appliances, those are physical. But financials, what we are going to purchase from there are stocks, bonds, notes, and mortgages. Those are in the form of securities. They call that one as financial securities or financial assets. And there are other actually financial securities like derivatives, that is more advanced type of financial securities. Second, we have the spot markets and the future markets. So spot is that you buy now, you can get it now. Future is that you are going to have a contract today, but the settlement or the transaction of selling and buying will happen in the future, or like in few days, a few months. So there are some in that will make the transaction more complex than the spot markets. The third one, in the investment, we're not only talking about the capital markets. We're not only talking about the long run. Like, for instance, you invest in the bonds for 5 years or 10 years. Also, in the stocks, we invest it for like indefinitely. There is also the money markets wherein the term of the investment, the intention is that it would be 3 or 2 months, like 30 days or 3 months. It's a high liquidity securities that some that are preferring to have that over the long term just to avoid the risk, because the shorter the maturity of your investment, the lower is the risk that will be involved, because the longer is the horizon of the period. Also, you cannot predict the future, so it will be subject to a lot of happenings than the short run. The fourth is the primary markets and secondary. When I say primary markets, this will happen if the corporation has stocks that are not yet issued. This is the background. For the security exchange, if the corporation apply for the stocks to authorize them to issue, so for instance, the security will give them like you are authorized to issue 10,000. However, in the ones that the corporation is authorized, they are not going to issue the whole 10,000 actually that were authorized. Sometimes they will just issue like 3,000 out of the 10,000. So what will happen now? The 7,000 that is not yet issued, those are not what they cannot call that one. They call that one as unissued securities, or those that are issued, they call that one as issued securities or outstanding securities. So if out of that 7,000 remaining, if the corporation decides to issue another 1,000 in addition to the 3,000 already issued, that is what we call the primary markets. We call that one as initial public offering, IPO. So there's a different selling price of that, or stock price. And the secondary market is like that. Somebody is already someone is already holding the type of the stock, but the shares of stocks is still listed in the stock exchange. And the buyer, if there's an interested buyer in there to buy your stocks that is already sold to a particular holder, so it means to say that the transaction is now not between the corporation and that interested buyer. It's now between the holder of the stock or security and the interested buyer. Okay, so I hope you understand that. Private markets, this is the fifth one, versus the public markets. When you say private markets, it means to say that the securities that you are you underwent with, that is underwent with the other parties, that particular securities is not available publicly. It means to say that it cannot be sold with the another. It's only between you and the other party or the other parties. While the public markets, let's say public markets, for instance, someone, if you issue bonds and someone buy your bonds, if that is a public, the bonds is listed in the financial markets. So the holder of the bonds now, the one who bought your bonds that you have issued previously, has the right now to transfer the bonds to the other. So it means to say that your creditor is no longer the one that is originally that you received the money. It could be with the other people or is and again interested with buying you the bonds. Okay, so there are some advantages or reasons is that of why is that the other parties are buying that from the other person. So that's the difference between the private and the public. So again, the point of having this a lot types of financial market, I mean financial assets is that or financial markets is to provide like to boost the efficiency of the financial market system. Why? Because the economy, a healthy economy is needing them. So it's dependent upon how efficient is the fund. So if there are a lot of choices, then there are a lot of, since investors have a lot of preferences when it comes to the character or how the financial securities are packaged. Say, for example, if there are some bonds that are not really straight bonds, for instance, bonds that are, we call that one as convertible bonds. It means to say that a certain period, you can have the right to convert the bonds into stocks if you prefer to shift from being an a creditor to investor. And there are also derivatives that are a lot of features that are included in there. So it means to say, I mean it's the features of every security is not what you call this one. It's not limited to the ideas of what we have now. So evolved later on or in the future. Again, the point of having that features, repackaging the financial securities is that we are going to promote the efficiency of the financial system, the efficiency of fund transfers from those people who need the funds and for those people who can provide those funds.